Every nation on earth is drowning in debt. That isn't a metaphor, it's the operating system of the global financial order. Spend, borrow, inflate, repeat. Within that system, banks are supposed to be the pillars of stability. But pillars crack. And in March 2023, one of those pillars shattered. Silicon Valley Bank, the 16th largest bank in America, evaporated in just 48 hours. $250 billion in assets, gone. 3 days later, Signature Bank collapsed. Then First Republic, 3 failures, 8 weeks. The biggest banking shock since 2008. The media insisted it was contained. The Federal Reserve assured everyone it was under control. They printed over $300 billion in emergency facilities, guaranteed uninsured deposits, and performed the same ritual the public has seen for a century. Do not worry, the system is stable. But that was 2.5 years ago, and as history has always warned, the first explosion is never the real catastrophe. It's simply the opening chapter. SVB, Signature, and First Republic weren't the crisis, they were stage 1, a warning shot disguised as a headline. The beginning of a 5-stage collapse pattern that has repeated across 4 countries and an entire century. Since that moment, we have been living inside stage 2, a quiet emergency concealed by calm press conferences and artificially stabilized numbers, the kind of silence that comes before structural beams buckle. The Federal Reserve's emergency window quietly pumped hundreds of billions into regional banks. Regional bank stocks are still down 30 to 40% since 2023. Commercial real estate, the fuse in every banking crisis, has only deteriorated further. Office buildings stand 20% empty, hollow monuments to a remote work revolution. Major cities report property values down 50%, and $1.5 trillion in commercial real estate loans will soon require refinancing at interest rates triple their original cost. For 32 months, America has been balancing on a temporary bridge, a bridge made not of stone or steel, but of borrowed time. And in January 2026, just 6 weeks from now, that bridge collapses into Stage 3. Stage 3 is the moment forced mergers begin. The moment hundreds of regional banks discover they cannot survive refinancing reality. The moment the FDIC begins arranging shotgun weddings between dying regional banks and the mega banks that already dominate American finance, JPMorgan, Bank of America, Wells Fargo. It is the moment when your hometown bank, the one that financed your first home or business, disappears overnight into a mega structure you never chose. This is not a new story. It is a pattern, a 5-stage pattern that played out in the United States in the 1,930 seconds, in Japan in the 1,990 seconds, in Iceland in 2008, and in Cyprus in 2013. And every time, it ends the same way. 90% of banks wiped out, a handful of mega banks controlling everything, depositors losing access, losing choice, and eventually losing money. The United States already completed Stage 1 in 2023. We are deep inside Stage 2. Stage 3 begins the moment the commercial real estate refinancing wall is hit in early 2026. To see what comes next, we must revisit the clearest blueprint of all, America nearly a century ago. In 1929, the United States had 25,000 banks. Most were small, community-run, deeply local institutions. Banking was fragmented, decentralized, and human. That world ended when the stock market collapsed 89%. Banks that had lent money to speculators took immediate damage. But that wasn't the true death blow. The real disaster was what followed. Small agricultural banks failed first. Farmers couldn't repay loans after crop prices collapsed. One failure created fear in nearby towns. Depositors panicked, withdrawing their savings. Bank runs spread like cracks across ice. In 1930 alone, 252 banks collapsed the same layer of the system that cracked first in 2023. The Federal Reserve could have flooded the system with liquidity. Instead, they decided the failures were healthy, a cleansing of the weak. So, more banks died. 2,294 in 1931, 1,456 in 1932. Over 5,000 gone in 3 years. But more importantly, each collapse fed the giants. Large banks absorbed small ones. Power concentrated. This pattern wasn't random. It was economic gravity. And by 1933, consolidation became official policy. The FDIC was created not to preserve small banks, but to oversee their absorption. Roosevelt declared a bank holiday, shutting all banks for 4 days. Only the institutions the government deemed sound reopened. The rest remained locked, deposits trapped, frozen. People eventually recovered partial amounts, but not all, and never when they needed it. By 1934, the U.S. banking system had shrunk from 25,000 banks to 14,000. By 2000, only 8,300 remained. Today, The four largest banks hold 45% of all deposits. The consolidation never reversed. Crises don't decentralize power, they compress it into the hands of fewer institutions. The parallel to 2023 is unavoidable. Regional stress has already happened. Emergency measures have already stretched 32 months. Forced mergers are 6 weeks away. Deposit seizures? The legal framework already exists. The pattern is not forming. It is unfolding. And once again, the United States is following the script line by line. Japan, in the 1,990 seconds, offered the world another demonstration of the same pattern, unfolding with different actors but identical choreography. At the start of that decade, Japan's banking system was considered the strongest on earth. Its major banks stood among the largest in the world by assets, and its economic miracle appeared unshakable. Then a single pillar collapsed: real estate. During the 1,980 seconds, property prices in Japan had soared by more than 300%. Banks lent trillions against land they believed would rise forever. When the bubble finally burst in 1990, property values began falling relentlessly, eventually sinking 60% over the next decade. Suddenly, entire loan portfolios were underwater. But instead of admitting the losses, banks hid them, smoothing their balance sheets with accounting tricks and optimism. Small regional banks cracked first, just as they had in America during the Great Depression. Credit cooperatives and local lenders that had fed Japan's construction boom were now choking on bad loans. These institutions were already insolvent, but regulators allowed them to continue operating. Japan created the zombie bank, dead but still walking. The emergency phase that followed was long and slow, unlike the sharp shocks of 1,930 seconds America. The Bank of Japan cut interest rates, launched support programs, and quietly propped up institutions that were structurally broken. For nearly a decade, the nation pretended that its financial sector was healthy, while beneath the surface, a banking system was rotting. Economists called it the lost decade. In reality, it was a 10-year stage 2, pretend, extend, delay. Eventually, the crisis reached a point where denial was no longer possible. By 1999, the Japanese government began forcing bank mergers on a scale the country had never seen. This was stage 3 consolidation by decree. The Industrial Bank of Japan, Fuji Bank, and Daiichi Kangyo Bank were combined into Mizuho. Sumitomo absorbed Sakura. UFJ was folded into Mitsubishi Tokyo Financial Group. What had once been 21 major banks was compressed into just 3 megagroups. This wasn't efficiency, it was survival. The same strategy used in America during the 1,930 seconds, and the same strategy the FDIC deployed with First Republic in 2023. Large institutions were allowed to grow larger, so the system could swallow losses without exploding. The casualties were competition, diversity, and small businesses that depended on regional lenders. Depositors paid a hidden price. While Japan didn't seize deposits directly, it used a softer but equally destructive mechanism: zero interest rates. For more than 20 years, savers earned nothing. Meanwhile, gentle inflation eroded their purchasing power year after year. It was a slow-motion confiscation, silent, technical, and irreversible. The cost of stabilizing the banks was transferred quietly onto the population. And as always, the final stage took shape quietly. Today, Japanese banking is controlled by a tiny cluster of mega institutions. Smaller banks are rare, and competition is nearly non-existent. The lost decade became a lost generation. The pattern had repeated perfectly: regional cracks, emergency support, forced mergers, deposit erosion, and oligopoly control. By 2013, the world would watch that same pattern again, this time compressed into a violent, one-week crisis in Cyprus. Cyprus was a small country with a large banking system, swollen with deposits equal to 8 times its GDP. That money, much of it foreign, had been funneled into Greek government debt. When Greece restructured its bonds in 2011, Cypriot banks were left with enormous losses. By 2013, the nation's 2 largest banks were functionally bankrupt. Regional stress hit instantly. Depositors panicked, withdrawals surged, bank runs rippled through the country. Cyprus had only 1 week to act before its banking system collapsed outright. The emergency phase was brutally short. The European Central Bank gave Cyprus an ultimatum: fix your banks or lose access to emergency liquidity. No negotiations, no extensions. The countdown began. Then came the forced merger. Laiki Bank, the second largest bank in the country, was simply shut down. Its assets were transferred overnight to Bank of Cyprus. Depositors woke up to a new financial reality: their bank no longer existed. What followed was the most shocking element: the bail-in. For the first time in modern European history, Depositors with more than 100,000 euros saw their money seized to recapitalize the bank. Everything above that threshold was cut nearly in half. If you had 200,000 euros, you lost 47,500 instantly. ATMs were restricted. Accounts were frozen. Money could not leave the country. It was a financial quarantine. And once again, Cyprus emerged with a single dominant bank controlling nearly everything, the inevitable final stage. The precedent terrified Europe. Deposits, if large enough, were not protected. They were emergency fuel. The pattern repeated in Cyprus just as it had in Japan and just as it had in America decades earlier. And now, that same pattern is unfolding in the United States again. Regional stress always begins at the edges. Agricultural banks in the 1,930 seconds. Credit cooperatives in Japan. Greek-exposed banks in Cyprus. In 2023, it was Silicon Valley Bank, Signature, and First Republic, not tiny banks, but regional ones, vulnerable to the same systemic risk. The collapse in value of long-term bonds combined with rapid, concentrated withdrawals. Stage 2 followed instantly, as it always does. Liquidity injections, guarantees, new lending facilities, temporary calm. But the underlying issue, the deterioration of commercial real estate, continued spreading beneath the surface. Now the calendar is closing in on January 2026, when the refinancing wave begins. Loans written at 3% must be refinanced at 8%. Buildings worth 10 million sell for 5%. Banks holding billions in these loans will be forced to acknowledge losses they've spent years hiding. And when they do, Stage 3 begins exactly as it did in Japan, in Cyprus, and in 1,930 seconds America, forced mergers. Very few institutions want to acquire a failing regional bank, but regulators will insist, just as they did when JPMorgan absorbed First Republic. The FDIC will cover the losses. The acquiring bank will take the deposits. And the American banking landscape will contract rapidly. This is not speculation. It is the historical pattern, one that has never broken, one that always accelerates as soon as Stage 3 begins. And we are 6 weeks away. The United States is entering the phase of the pattern where the script tightens, the tempo accelerates, and denial becomes impossible. March through May 2023 marked the first fractures: Silicon Valley Bank collapsing on March 10th, Signature Bank on March 12th, and First Republic on May 1st. 3 institutions that collectively held more than $500 billion in assets evaporated in 8 weeks. People pointed to rising interest rates as the cause, and in one sense, that was true. These banks had purchased long-term bonds when yields were low, and as the Federal Reserve pushed rates from 1% to 5%, the market value of those bonds fell by 30 to 40%. Silicon Valley Bank alone had more than $120 billion in unrealized losses sitting on its balance sheet. When depositors finally realized the hole was too deep to ignore, they ran, and the bank collapsed in 48 hours. But underneath the headlines, another crisis was forming, one that the public didn't see, one that most still don't. The deeper cause wasn't bonds, it was commercial real estate. Regional banks in America hold 70% of all commercial real estate loans, nearly $3 trillion. These loans were written during an era of cheap money, when interest rates were low and buildings were full. Office towers, retail centers, apartment complexes, properties that made financial sense when money was inexpensive and occupancy hovered near 95%. But then, the world changed. Remote work hollowed out cities. Office occupancy fell to 80%. Rents stagnated. Property values sank. Most of these loans mature between 2025 and 2027. And when they do, borrowers must refinance at far higher interest rates. A loan that once cost $300,000 a year in interest suddenly costs $800,000. The math doesn't work. Cash flow turns negative. Defaults begin. Banks repossess buildings worth half of what they lent. Losses cascade. This is the quiet fuse burning under the financial system. And it is the reason Stage 2 has lasted 32 months longer than regulators expected, but far more fragile beneath the surface than the public realizes. The Bank Term Funding Program, created in March 2023, was a temporary patch. It allowed banks to borrow against their underwater bonds at full value, sidestepping losses that would have otherwise forced immediate failures. More than $300 billion was borrowed through that program. It expired in March 2024, but its ghost remains. Many regional banks still owe that money, still hold the same bad bonds, and still hope that somehow rate cuts will lift them back to safety. But the truth is simple. Those bonds will not recover in time, and the commercial real estate loans coming due will expose far deeper weaknesses. The first warning came in January 2024, when New York Community Bank nearly collapsed. Commercial real estate losses tore a hole through its capital position. Emergency funding kept it alive, but the message was unmistakable. The cracks were widening. A dozen other regional banks are in similar condition, only quieter, only slower, only hidden behind accounting and optimism. And in January 2026, the first major wave of maturing commercial real estate loans arrives. The clock is nearly out of time. Stage 3 will not be subtle. It never is. It begins when regulators step in and announce that banks can no longer remain independent. When the FDIC arranges shotgun marriages between weak regional lenders and megabanks that agree reluctantly, publicly, and profitably to absorb them. The First Republic acquisition revealed how this works. JPMorgan did not want the bank not on economic terms alone. But with FDIC guarantees covering 80% of First Republic's expected losses, the deal became irresistible. JPMorgan gained deposits, prime clients, and new geographic reach, while taxpayers and the FDIC absorbed the risk. This is the template for Stage 3, the same template used in 1933, in 1999 Japan, and in Cyprus in 2013. Once the FDIC begins coordinating these takeovers, the dominoes fall quickly. Regional bank stocks, already down 35%, could fall another 50%. Confidence erodes. Depositors begin shifting money preemptively to the safety of megabanks or treasury bills. The regional system, starved of deposits and facing losses, buckles. 200 to 400 banks may disappear between 2026 and 2027, not necessarily because they were reckless, but because the refinancing math became impossible. Commercial real estate does not forgive, and the institutions most exposed to it aren't the giants, they are the regional and community banks that built American towns, financed American small businesses, and anchored local economies. Stage 4 is the phase that few Americans know is even legally possible, but the Dodd-Frank Act made it real. Under Title II, regulators have the authority to conduct bail-ins when a bank fails converting uninsured deposits into equity to recapitalize the institution. The phrase is technical, but the effect is simple. If you have more than $250,000 in a single bank, the amount above that threshold can be taken to save the institution. This isn't speculation, it's codified law. Most Americans genuinely believe FDIC insurance covers everything. It does not. Deposits above the insured level are unsecured liabilities, the same category as bondholders. In a crisis, they become fuel. This is exactly what happened in Cyprus when 47% of large deposits were confiscated. It is what Japan did more subtly through decades of near-zero returns. And it's what the United States is structurally prepared for in 2027 or 2028. When the first American bail-in occurs, panic will spread instantly across regional banks. Depositors with large balances will race to transfer funds to JPMorgan, Bank of America, or into Treasury bills. The very act of fleeing will accelerate the crisis, pushing more regional banks into insolvency and forcing more bail-ins. This is how Stage 4 transforms into Stage 5, the final state, the endgame of consolidation. By 2030, America may have fewer than 3,000 banks. The top 4 institutions could control as much as 70% of all deposits. Regional banks, once the backbone of American entrepreneurship, may become relics of the past. Small businesses would struggle for credit. New ventures would face stricter hurdles. Megabanks, prioritizing safety and scale, would ration capital with caution, slowing the nation's economic engine. The power dynamics of American finance would shift permanently. When only 4 institutions dominate the flow of money, they do not compete on service. They set terms. They dictate fees. They decide who gets financing and who does not. This is the path the United States is walking right now, step by step, stage by stage, following the same arc as the nations that came before. And the timeline is no longer measured in years. It is measured in weeks. Stage 1 happened in 2023. Stage 2 is ending now. Stage 3 begins in January 2026, and once it begins, the cascade accelerates. Stage 4 follows in 2027 or 2028. Stage 5 takes root by 2030. The pattern has never failed, and it is unfolding again in plain sight. If you want to understand what the next 4 years of American banking will look like, you don't need prophecy, you only need memory. The pattern is not imaginative, it is mechanical. It does not care about intention, ideology, or optimism. It is a machine that has run 4 times before, and every time it ends the same way. The path the United States is walking now is not unique. It is the exact trajectory Iceland experienced in 2008, though in a far more explosive form. Iceland's banks had expanded to more than 10 times the size of its economy. When the global credit markets froze, all 3 of the country's major banks collapsed within days. Depositors were frozen out, foreign creditors were wiped. The government nationalized what it could and let the rest burn. And once the fire was out, Only a shrunken version of the system remained, consolidated and controlled. Different country, different scale, same pattern. Every crisis starts at the edges, weak points crack, emergency support arrives, but support never fixes the core. It only buys time, time that always ends. That's where America stands today, the final stretch of borrowed time. The timeline is so precise because it's dictated by loan maturities and balance sheet math, not politics. The commercial real estate refinancing wave is not a theory, it's a calendar event. Those loans will mature in 2026 and 2027. Banks will have to recognize losses, and regulators will respond with the same playbook they've used since 1933. Every stage is already in motion. Regional banks across the U.S. know what's coming even if the public doesn't. Executives see the declining values in their commercial loan books. They know occupancy rates aren't recovering fast enough. They watch as borrowers quietly attempt extensions, restructurings, anything to delay the refinance cliff. But time is not elastic forever. At some point, the loan must be rewritten and the new math kills the deal. A $10 million building financed at 3% was manageable. At 8%, it becomes a burden. At 10%, a death sentence. And when the borrower walks away, the bank is left with the building. A building nobody wants at the price the bank needs. Multiply this outcome across thousands of properties, and you have the skeleton of stage 3. Banks don't fail because of one loss. They fail because losses compound faster than confidence can be restored. They fail when depositors feel a tremor and take precautionary action. They fail when investors see a pattern and pull capital. They fail when regulators decide survival requires sacrifice. And sacrifice in stage 3 means consolidation. The FDIC does not let dozens of banks collapse openly. That would create the kind of panic that destroys trust in the system. Instead, they orchestrate silent takeovers, mergers announced at 6 a.m., after agreements hammered out overnight. Customers wake up with new account numbers, new mobile apps, and new terms. They are told it's for their protection. In reality, it is for the survival of the system. And as regional banks disappear one by one, something subtle but irreversible happens. People stop seeing banking as a competitive landscape and start seeing it as an inevitability, a destination, a funnel. Money flows uphill toward the biggest institutions because that's where the government backstop is strongest. Safety becomes synonymous with scale. When the first U.S. bail-in happens, and history suggests it will, the psychology of savers will change instantly. People with large balances in regional banks won't wait for clarity. They'll move their funds to JPMorgan, Bank of America, Wells Fargo, or straight into U.S. Treasuries. Not because they distrust their local bank, but because the system is forcing them into the arms of giants. This accelerates the very consolidation that created the fear in the first place. Fear creates motion. Motion creates imbalance. Imbalance creates collapse. Collapse creates consolidation. Consolidation creates oligopoly. And oligopoly is the final shape of the pattern. By 2030, the American banking landscape may resemble an inverted pyramid, with a narrow cluster of megabanks at the top carrying the weight of the entire financial system. They won't just hold deposits, they'll define the terms of economic life. They'll decide what kind of loans are acceptable, which businesses are too risky, which startups deserve credit, and which communities get overlooked. Megabanks behave rationally, but their rationality is defensive. They prioritize safety, compliance, predictable returns. They avoid anything that looks uncertain. But uncertainty is where innovation lives, which means the economic fabric of the country will shift. Entrepreneurship slows when local banks disappear. Small businesses struggle when credit committees sit 4 states away. Real estate development becomes cautious and concentrated. Risk becomes something only the wealthy or institutional can absorb. The middle class gets pushed toward passive dependency not by design, but by structure. And structures, once built, are hard to dismantle. This is the world waiting at the end of the 5 stages. Not necessarily dystopian, but narrower, more concentrated, more controlled. A financial ecosystem that sacrifices diversity for stability, competition for predictability, and choice for the illusion of safety. And unless something unprecedented breaks the pattern, something that has never happened in 100 years of financial history, the United States is heading there at full speed. Stage 1 happened, Stage 2 is ending, Stage 3 begins in January 2026. The countdown is not years, it is weeks. The question is no longer whether the pattern will unfold. It is whether you recognize it before the gates close. What comes next is not a mystery, it is not a guess, it is not fear-mongering or prediction. It is simply the continuation of a sequence that began long before Silicon Valley Bank collapsed, long before the Federal Reserve launched emergency lending programs, long before the public was told the crisis was contained. The sequence began the moment rates rose and the value of long-dated assets broke beneath the surface. Once that damage was embedded, everything afterward became inevitable. Every time this pattern appears, it follows the same rhythm. The early shock, the quiet denial, the tightening spiral, the final consolidation. And the most sobering truth is that the public rarely realizes they're inside a historical transition until after it is complete. That's why Stage 3 unfolds so quickly once it begins. People assume banks fail loudly, with dramatic headlines and empty vaults. But in reality, most failures are administrative, surgical. The FDIC steps in late at night. Agreements are negotiated behind closed doors. Deposits are transferred before dawn. By the time the public wakes up, everything has already changed. The visible collapse is the smallest part of the event. The real collapse happens in accounting rooms, in spreadsheets, in quiet board meetings where numbers no longer add up and survival requires surrender. And surrender is what Stage 3 demands. Banks that have been pillars of their communities for 50 or 100 years will find themselves unable to stand alone. Their balance sheets won't support refinancing the new wave of commercial real estate losses. Their capital buffers will erode. Their liquidity will drip away. Some will try to raise emergency funding. Some will search for buyers. Some will hope for a last-minute cut in interest rates. But the truth is brutal. Interest rate cuts won't arrive in time to repair the damage. Even if rates fall in late 2026 or 2027, the loans maturing before then will already have detonated. This is why the timing is so fixed. This is why January 2026 is so important. This is why regulators are preparing behind the scenes. The FDIC already knows which banks are most exposed. They know which balance sheets are weakest. They know how many commercial properties are sitting on their books at valuations that no longer resemble reality. They are not waiting to discover what happens. They are preparing to manage what happens. And as they do, the consolidation accelerates not because it's malicious, but because it's the only workable solution the system has ever used. You can't save 1,000 struggling banks, but you can merge 100 into 10 and 10 into 4. This is how oligopolies form, not through conspiracy, but through necessity. As Stage 4 approaches, the legal mechanisms prepared in 2010 finally come into focus. The Dodd-Frank Act was created to avoid taxpayer-funded bailouts, but in doing so, it opened the door to bail-ins. And bail-ins shift responsibility from the government to the depositor. The moment a bank is placed into resolution, uninsured deposits become tools. They can be converted, frozen, or written down. And this is not a fringe interpretation, it is the letter of the law. It is the mechanism designed to keep the system functioning without taxpayer funds. But what protects the system does not always protect the individual. For people with balances above the FDIC limit, the risk is not philosophical. It is practical. It is mathematical. It sits in legal text, not hypotheticals. And once the first bail-in occurs, the psychology of depositors will change instantly. A single event will send billions racing toward the safety of treasury bills or mega bank accounts. That flight, that sudden, panicked movement will destabilize any regional bank still trying to stand. This is why Stage 4 is always the shortest phase. Panic compresses time, and once Stage 4 ends, Stage 5 becomes the new normal. Banking becomes a narrow funnel. A small set of institutions hold the nation's deposits, dictate its credit, and shape its economic possibilities. Innovation slows. Risk becomes centralized. Small businesses struggle for financing. A country built on decentralized dynamism becomes dependent on centralized discretion. That is the world waiting on the other side of 2030 if nothing interrupts the pattern. And here is the truth. Patterns like this don't break on their own. They break when people recognize them early. They break when individuals prepare ahead of time. They break when the public stops assuming the system is invincible and starts understanding that the system behaves according to predictable, historical laws. Every major banking crisis of the last century followed the 5 stages: regional cracks, emergency support, forced mergers, deposit losses, and the rise of oligopolies. The United States is not exempt from history. It is following history. Stage 1 happened in 2023. Stage 2 is ending now. Stage 3 begins in January 2026, 6 weeks away. Stage 4 arrives in 2027 or 2028. Stage 5 is permanent. The timeline is not theoretical. It is already unfolding. The question that remains is the only question that matters. Will you be prepared when Stage 3 begins? Because when it starts, it moves fast. And when it's visible to everyone, it's already too late.